there are many more signs that this inflationary picture is very, very, very strong still. Is there any end in sight?
Hi, good morning. I mean, absolutely. There are signs everywhere regarding inflationary pressure. But I think the key thing right now is you're starting to see inflation expectations rolling over. You can look at multiple indicators that show that, whether it's the 5-year break-even rates, etc. And that's critical because there's a big difference in the narrative of inflation, which is high and accelerating, versus inflation, which is high and moderating. And in terms of what you've mentioned about demand destruction, inflation has been the key components behind that demand destruction. So if that starts slowly moderating, hopefully you will see demand start to pick up again.
You know, it's interesting, Anneka. We were sitting here kind of going through some of the data before the show, and one of the big stories that's kind of making its way through the rounds right now is the severe drop in lumber prices. Now, lumber I mentioned because it was one of the poster children, so to speak, of that inflationary picture over the last kind of year and a half, 2 years or so. Is that something that we see happening with regard to the rest of the inflationary picture, that we do see that when prices get to a certain point, if it is discretionary in nature, people tend to just shy away?
Absolutely. So, I mean, we have to always remember the comparison base because, you know, we're all obsessed with the year-on-year changes. But let's go back to May 2021. Let's look at what, you know, the vaccination rate in the US was. Let's look at the level of economic activity. So the comparison base in terms of year-on-year inflation figures starts easing massively. And that's also a big driver as to why expectations are coming down. To your point about the different sources of pricing pressure, that's exactly it. Look at what Manpower was saying, for example, about wage inflation, that at one point companies say, well, we've done as much as we can. You're seeing that roll over in multiple sources of pricing pressure, which is what bond markets are telling us, that we could finally start seeing moderation in this area.
And if you were to say to your clients, the people who are asking you about how positioning should be looked after in terms of this kind of a situation, what exactly do you do? We've seen a lot of moves here towards things like utilities and consumer staples, despite the fact you have rising interest rates that erode the power of some of those dividend payments. Why the defensive tilt, and is it justified?
Yeah, well, I mean, it's something I've mentioned earlier, and I'm going to keep on mentioning it because what we've seen is a massive destruction in some, you know, a massive valuation change, right? The egregious era of very, very rich multiples, that's gone. To a certain extent, that's also what the Fed was trying to achieve. So we've lost sort of 3 PE points in terms of valuations. What market participants, what asset managers need to look at now is the E of the PEs, because that can be very, very misleading. You can look at stocks which appear very, very attractive because, as said, 3 PE points have essentially been vanished. But is that E realistic? Is that E sustainable? We've started to see estimate downgrades come in, but we have to sort of see more and more evidence of which companies are able to truly generate the cash flow to support the businesses and which ones simply aren't.